Bismillahirrahmanirrahim. In the previous class, we were discussing about basic accounting principles and guidelines. In that, we discussed about economic entity assumption, monetary unit assumption, time period assumption, and cost principle. Today, we are going to discuss just a minute. It will be much more clear. Full disclosure principle. Now, what is basically full disclosure principle? According to this principle, if certain information is important to an investor or lender using the financial statements, that information should be disclosed within the statement or in the notes to the statement. What does it mean? This is your financial statement, any financial statement, suppose balance sheet. Now here is some important event this year, 2019 suppose. There is an important event, this one, here, any event. Now you will disclose this event here in footnotes that this thing happened here. This is called full disclosure. Full disclosure means any important event happened in a particular year must be disclosed in the footnotes. Below income statement, balance sheet, cash flow, there are some theoretical writing. These writings, these are basically footnotes. Now what is he saying? It is because on this basic assumption, accounting principle, that numerous pages of footnotes are often attached to financial statements. When you will see a financial statement, below financial statements, there are some notes attached, 2-3 pages of notes. These notes are called footnotes, and we call it disclosure. We are disclosing important events. So according to this principle, any important event in a financial statement must be disclosed in the footnotes below the financial statements. Now here is an example. Let's say a company is named in a lawsuit. Suppose there is a case in the court against the company that demands a significant amount of money. Now when you will fight against someone in court, so it will cost you. When the financial statements are prepared, it is not clear whether the company will be able to defend itself or whether it might lose the lawsuit. Now there is possibility, maybe the company will win the case or maybe the company will lose the case. So we don't know. If you don't know, so what will happen? You will disclose this thing in the event that there is a lawsuit against the company in the court, and there is possibility that we will win or there is possibility that we will lose. As a result of these conditions and because of the full disclosure principle, the lawsuit will be described in the notes to the financial statements. So because of this thing, you will disclose this important event in the financial statement. A company usually lists its significant accounting policies as the first note to its financial statement. So, whatever, any important event, any significant event must be disclosed in the notes below financial statements. So, just like I sold, suppose you purchased a piece of land this year. So, now here you will disclose it. This is an important event. So, any important event in the financial statements must be disclosed in the footnotes below the financial statements. The next principle, it is going concern principle. Going concern principle means when you start a business, your aim will be that this business will be continued for a long period of time. Whenever someone is starting a business, so his aim is that he will run this business for a long period of time. This is called going concern principle. Suppose I am starting a cement factory. So what will be my aim? That this business, I will carry on this business for a long period of time. This is called going concern principle. This accounting principle assumes that a company will continue to exist long enough to carry out its objectives and commitments and will not liquidate in the foreseeable future. That there is no aim that we will liquidate the business in the coming years. So going concern principles means any time when you are starting business, so your aim is that you will run this business for a long period of time. If a company's financial situation is such that the accountants believes that the company will not be able to continue on, the accountant is required to disclose this assessment. But sometimes if you're running the business and in the life of business there is a time that accountant is thinking that now the business will not survive, so he will disclose this thing in the footnotes that there is very less possibility that the business will continue its business. So going concern principle shortly means whenever you're starting a business, so the aim of the business is that it will continue for a long period of time. When you are starting a school, so your aim is, now you don't know about the future, but your aim is that it will continue for a long period of time. Maybe in the future something happened and it will be difficult for you to continue the business, but your aim is that I will run this business for a long period of time. The next principle, it is called matching principle. Matching principles mean that revenues of one accounting period will be matched with the expenses of the same accounting period. Revenues minus expenses. Revenue of 2019, you will write it in 2019 financial statement. And expenses of 2019, you will write it in 2019 financial statements. Revenue of one accounting period cannot be transferred to the other. If you are writing revenue which belongs to 2019 and you're writing in 2020, you are violating this principle. If expense of 2019 you're writing it in 2020, so you are violating the matching concept. So according to matching concept, revenues of one accounting period will be matched with the expenses of the same accounting period. This accounting principle requires companies to use the accrual basis of accounting. Okay, there are two systems of accounting. One is called cash basis. And one is called accrual basis. Now, what is the difference between these two? In cash basis of accounting, transaction will be recorded when cash is received or cash is paid. Suppose you sold goods on credit. In cash basis of accounting, you will not record it. I'm telling you, sold goods on credit. $1,000. Cash is not received. This is January 5, suppose. The company sold goods whose value is $1,000. You will not record it in cash basis of accounting because you will record the transaction at that time when cash is received or cash is paid. But here, no cash is received, no cash is paid. So you will not record this transaction in cash basis of accounting. If you purchase goods, suppose instead of sale, you purchase goods on credit. You didn't make payment, so you will not record this transaction. Transaction will be recorded only when cash is received or cash is paid. This is called cash basis of accounting. In cash basis of accounting, transaction will be recorded only when cash is received or cash is paid. Here, in these two transactions, when you sold goods on credit, nothing is received, so you will not record it. When you purchase goods on credit, so nothing is paid, you will not record it. This is called cash basis of accounting. The other is accrual basis. In accrual accounting, now these transactions will be recorded. In accrual basis of accounting, transaction will be recorded when the ownership is transferred. When you sold goods on credit and goods are sent to the purchaser, now in that case you will record the transaction because the ownership of goods is transferred. Suppose sold goods on credit $1,000 to Ali. So now here Ali received the goods. When Ali received the goods, ownership is transferred to Ali. Now we will record this transaction. Cash is not received, but still we will record this transaction. Purchase goods on credit 1000. So you purchase goods, ownership is transferred to you, you didn't make payment, but still you will record this transaction in your book in accrual basis of accounting. So these are two different concepts: cash basis of accounting and accrual basis accounting. The matching principles required that expenses be matched with the revenues, that you will match the revenues with expenses, because when you want to calculate profit, you will match revenues with the expenses. For example, sales commission expense should be reported in the period when the sales were made and not reported in the period when commission were paid, just like I told you. Suppose we sold goods on credit. This is 2019 and 2019 December. You didn't receive cash. You will receive cash in 2020. Suppose this was 145 days credit period. So you will receive cash in 2020, but you will not record this transaction in 2020. You will record this transaction in 2019. According to accrual basis of accounting, transaction will be recorded in the books when the ownership is transferred. Now ownership is transferred in 2019. When you sold goods to Ali, ownership is transferred to Ali. So you will record this transaction in 2019, not in 2020. Okay. Wages to employees are reported as an expense in the week when employees worked and not in the week when employees are paid. Just like the previous example. Suppose these are employees. If we convert week to month, suppose employees work in December 2019. Their total salary, it is $100,000. They give services, the employees give services in December, but mostly we are making payment in January. So payment will be made here. But since this work is the work of December, so you will record it in December 2019, not in January 2020. Employees are working for us in December, but we are making payment on the 5th or 6th of January. According to accrual basis of accounting, transactions will be recorded in that year or in that month in which they perform their services. So here the employees performed or provided services in 2019. So we will record it in 2019. Payment is made in 2020, but we will not record it in 2020 because this is accrual basis of accounting. If a company agrees to give its employees 1% of its 2015 revenues as a bonus on January 15, 2016, the company should report this bonus as an expense in 2015. Now here is another case. In 2015, the whole year's employees perform their duties, and company announce that we will give a bonus because of their excellent performance. But bonus will be paid in 2020. Oh, sorry, 2016. But since this bonus is the reward of the duties in 2015, we will record it in 2015 and not in 2016. Employees worked in 2015, their performance was good, the company announces a bonus. Now, since this bonus is related to 2015 duties, we will record this as an expense in 2015 and not in 2016. This is basically matching concept. Because we cannot measure the future economic benefit of things such as advertisements, and thereby we cannot match the advertisement expense with the related future revenues, the accountant charges the advertisement amount to expense in the period that the advertisement is run. To learn more about this, leave this. Simply make it simple. Revenues of one year cannot be transferred to the other year. Expenses of one year cannot be transferred to the next year. This is matching concept. Revenues of 2015 will be matched with the expenses of the same year, 2015. You cannot transfer revenue of one accounting period to the other. You cannot transfer the expenses of one accounting period to the other. This is called matching concept. The next principle, it is revenue recognition principle. Under the accrual basis of accounting as opposed to the cash basis of accounting, revenues are recognized as soon as product has been sold or services has been performed. Just like I told you in the previous, like we purchased goods or we sold goods. When we sold goods on credit, you will recognize the revenue. In cash basis of accounting, revenue will be recognized only when cash is received or cash is paid. But here, revenue will be recognized when the product has been sold or the services has been performed. This is revenue recognition principle. That revenue will be recognized at the time when the product has been sold, when product is sold and ownership is transferred and services has been performed or we perform the services. Regardless of when the money is actually received. We are not concerned that when we will receive the money. We are concerned when the goods are sold and ownership is transferred and services has been performed. Under this basic accounting principle, a company could earn and report $20,000 of revenue in its first month of operation, but received $0 in actual cash in that month. Now here he gives an example that in 1 month Suppose this is the month of October. In October, we performed a service, and the value of that service, it is $20,000. But we didn't receive any amount, $0. We received $0. We received money, the whole money, $20,000 in November. Cash is received here, 20,000, but we provided services here. So we will record it in the month in which we provide the services and not in the month when we received cash. Received and payment of cash, ignore that. Revenue will be recorded to that month in which you provided the services. So we provide the services in in October. So we will record this revenue as October revenue and not the revenue of November when we received cash. Receipt of cash is not important. Just the services are important when you provide the service. Now here is an example. For example, if ABC Consulting completes its services at an agreed price of $1,000. There is an agreement that ABC Consulting will provide services for $1,000. ABC should recognize $1,000 of revenue as soon as the work is done. When the work is done, this money, $1,000, it will become the revenue of ABC Consulting. It does not matter whether the client pays the $1,000 immediately or in 30 days. Do not confuse revenue with cash receipt. Like here is another example that ABC Consultant, they provide services. They agreed that they will provide services of $1,000 in this month. Suppose November. When ABC will complete the work, they will record this thing here in November. Revenue of November. If they are receiving money or they are not receiving money. Don't confuse yourself with the receipt of cash. We are not concerned with the receipt of cash. If cash is received or cash is not. But this is the revenue of November. Suppose you received cash in December. 1,000. Now cash is received. But this is not the revenue of December. It is the revenue of that month in which the services are provided and not the revenue of the month in which cash is received. So simply when you complete the work in November, it will become the revenue of November. It will not be the revenue of that month in which cash is received. This is called revenue recognition principle. There are two other principles, but I think for today it is enough. Inshallah, in the next class, then we will talk about that. Assalamu alaikum.